We're back with our featured guest, Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Let's switch gears. We were talking about your investment strategies. No shortage of things to begin with. Let's talk about Washington to begin with. Investors just trying to figure out what can this administration now push forward in terms of its economic agenda when some of the most powerful business leaders in the country seem to be turning their back on the president.
It's a tough conversation, really, because there's two things that we want to see. We want to see that tax reform and repatriation of income. That would be very beneficial to the corporate America. I think the biggest risk in the market everywhere currently is policy mistake, whether it's on a political side, the two things that I just mentioned, whether it's on a Federal Reserve side with rate increases and or balance sheet normalization. So far, nothing has happened, and we kind of chuckled, you and I, in the commercial break, that doing nothing
maybe no news is good news.
Right, doing nothing also means you're not making a mistake, but can only last so far. So we're going to be looking for that going in the fourth quarter. This tax reform was supposed to happen way sooner. Both sides, the political rhetoric is absolutely so highly emotional. One of the highest emotionality I've seen in my career on both sides, Republicans or Democrats. How that plays into the market, obviously we're skirting highs minus a few percent.
So can we ignore that political noise and focus on what other fund managers have told me, the fact that the American economy has a lot of positive signs apart from the chaos in Washington?
100%. The regulatory environment, I think, was very... I understand why it was put in place during the financial crisis, but it was very detrimental from an investment point of view. Companies are much more confident investing in plants and machinery and growth in their business, and you can see that in the industrial economy. Industrials are doing very, very well. Industrial production is higher. Industrial metals are doing better, copper, zinc, as there is demand for them. So you see the industrial economy is doing very well. And the financials as well. The regulation is less stringent, allows for cash to come back into the economy at a time when the Fed wants to normalize balance sheet. So taking money out and on the other side putting money back in. So that offsets things, and it's more normalized for sure.
Now, you did say before we went to break that for the first time since February 2016, you are being careful over the short term, because a lot of things can trip us up.
Yeah. We are very, very disciplined, and we don't forecast the market, and we don't tell the market what they should be doing. We listen to what the market is doing. And so despite the fact that indices are hovering highs, the internals started to deteriorate. And mind you, internals started to deteriorate before North Korea happened last week, so that was just an excuse to sell off. Tomorrow we have expiry on the options. The head of trading, I watch this a lot. It can impact things. Vast majority of the market volume does not trade in a traditional fundamental manner. There's lots of program shenanigans, that asset allocations, volatility allocations, and with the volatility moving up and down in such a high fashion, we're talking up 20%, down 17%, that creates a lot of dislocation in these passive products. And we don't talk enough about the impact of passive products on pricing, because these passive products are not passive on the pricing. They're not price sensitive, so they can move things quite violently. That's not why we are hedged, and our portfolios are hedged, and we have about 10% cash, and that's the process we do. The market internals are deteriorating a little bit. On rallies, they're not really getting much better, those internals. And although the indices are pretty high, it's in the hands of fewer and fewer stocks. So it can last a little bit of time.
Or you can definitely make the argument. We talk about fewer and fewer stocks. You make the argument when you talk about the S&P 500 on any given day, what's moving it up, what's moving us down? Facebook, Amazon, right. Netflix, Google. So it's a handful of shares.
Right. And so internally things are deteriorating, but it's very, very good for active managers, because there are very specific areas that you can do well, despite for the money that stays in. So for those people that have new cash, please wait a little bit. For those people that are invested, please stay. And as an active manager, we have very specific targeted stocks.
Now, very specific targeted stocks. You have a few in mind, I understand. One of them is Raytheon.
Raytheon, defense. So the defense industry, so first of all, at the gut feel level, we know the world is bubbling up in all kinds of situations. South North Korea, Middle East, Europe, what's happening today in Barcelona. Defense spending as a percentage of GDP is on the rise in most countries, NATO, US, and so forth. The cycle is usually about 10 years, and last year we skirted bottom. It started going up. Once you start spending on defense, it's not a two-quarter thing. These are long-term contracts, and so it tends to ramp for a little while. Raytheon is one of the is an OEM and provides parts in the whole type of industries, including for, you remember the Iron Dome that was used for missile defense and so forth. That is newest technology. It throws off cash flow. It has long-term contracts, has visibility in a sector that has now started to strategically get money flown, put into it. And so that's one of the sectors that we target.
TakeTwo Interactive. Quickly, I want to ask you about that one too.
TakeTwo, gaming. Gaming has changed. Used to be 15 years ago, you bought a game, you brought it home, and that's it. Now it's interactive. The spending is internal. There's all kinds of, esports is one of the things that TakeTwo Interactive received revenue. They had fantastic earnings. In the last 2 weeks, they reported that recurring revenue was up 70%, and it's 50% of their total revenue, just as a metric. So they're looking to give scholarships to children for esports. So the whole industry is changing a lot, and it's very nice.
I have two sons, 14 and 12. A couple months ago, we were having trouble with their internet. We got to sort it out. It's the high-speed stuff now, but they're like, oh, I said, well, the internet's going to be down for about a day. Just go play a video game. And they looked at me like I had 3 heads. It was like,
no, you can't do that anymore.
Just, you have a TV, you have a box. It's like, without the internet, it was nothing.
That's right. It's not interactive.
Yeah. Different world than we grew up in. All right, Diana, always a pleasure to have you here. Thanks for joining us.
Thank you very much.
Diana Avigdor from Barometer Capital Management.